too much game, there's too many lawyers, there's too many accountants, too many CPAs, there's too many people out here that are exchanging value, exchanging information, and exchanging business cards that's out here trying to get it. This is the DMV. This is the ultimate networking hub. If you're not here, you're missing out.
We are ready to get started, everyone. So I want to take a quick moment to introduce myself, introduce our lovely panel that's joining us today, and welcome you to the first DMV Happy Hour meetup of 2024. I want to take a quick shout out for all my day ones who've been coming to my events from the very beginning. I appreciate you all, and thank you for joining me again tonight. So tonight's event was essentially, it kind of comes full circle in terms of how I came up with the idea to produce this event. A couple of my colleagues in the real estate circle and in law, both Keisha and Alex, came to me with the idea to first start with trademarks, and then of course you know me, for those who know me, always extra, always looking to figure out how I can do something bigger. And so I myself was in the market to, obviously master my taxes and really think through what that looks like as a real estate investor, as an events management owner, and an HR consultant owner. And then 2 years ago, one of my goals was to make sure that I secured and protected all of my assets in real estate, and I was connected with a Black Women Investment Group that referred Amy to me 10 times over, and I was able to connect with her and get my trust and estate situation lined out for one of my 2023 goals. I had such an amazing experience that it was important for me to make sure that all of you all get an opportunity to know her as well. And I noticed several of you all already are aware of her, so that's great. And then also, those are quite a few of you all in here are entrepreneurs yourselves. I want to make sure that you got a chance to meet Keisha, who is a trademark attorney and can help you with that. And then of course, Sharice Small, I was connected with via LinkedIn. And he is a licensed real estate tax attorney, but also can handle anything tax related. He's also an investor and a developer, and is a wealth of knowledge in general. So hopefully you all will get a wealth of knowledge from the individuals on the stage tonight. And I did capture every single one of you all's questions for tonight. So we're gonna tackle those, and then we'll open up the floor for those of you all who didn't register beforehand, but may have some questions as you are listening to them. So we'll address that, and then we'll end with some post-event networking so you get a chance to interact with the panel if you haven't already, and then of course those in the room. So without further ado, we're gonna get started. So we're gonna start with you, Keisha. We're gonna basically just go down the line with all of your all's questions, and then we'll just kind of scroll back. Okay, so they have to test the mic out. Okay, so Keisha, first question that came in for you was, how has the corporate, and this question came in for really all of you all, in terms of how has the Corporate Transparency Act affected your practice? I'll let you start. Oh, I'm sorry, let me back up. Let's do a full intro. I'll let Keisha tell you a little bit about her. Okay, that might be you. Okay, all right, so we're gonna let her introduce herself, tell you a little bit about her background. Same thing with Sharice, same thing with Amy. So go ahead, sorry about that.
Good evening, everyone. My name is Keisha Joaquin, and I am the founder and managing partner of K&A Law Group. We specialize in trademarks, copyright, business formation, and immigration law. I have been in the legal field for over 15 years now. I worked my way up from an unpaid legal intern to now owning my own practice. I am originally from Boston, go Celtics, but I've been in the DMV area for about 13 years now, on and off. So thank you for joining us tonight.
Good evening, everyone. First, Megan, thank you for this opportunity to come and speak. My name is Sharice Small. I'm president and CEO of SGS Financial Firm. There we go. That's hello. Testing 1, 2, 3. So yeah, Sharice Small, president and CEO of SGS Financial Firm. We are a tax accounting, business consulting, financial planning practice. We work with small businesses and nonprofits and make sure that you got your books in order. Because what I see with people that start their business, they focus on the front end, the sales and the market, and they neglect the back end. I've seen too many pay too much in taxes, or they don't pay taxes at all. So we make sure that you have the right system in place. You got to know your numbers. If you don't know your numbers, you can't grow your numbers. Have those profit and loss statements, those balance sheets. So the right structure, the right system in place. We've been in business for 20 years. We are actually in Baltimore, but we have clients all over. In addition to my tax accounting practice, I also have a real estate development company. We own commercial buildings, we own apartment complexes. Been in the real estate game for just about the same 15 to 20 years as well. In addition, I have a nonprofit called Financial Power Movement. We teach kids community financial literacy, entrepreneurship, and real estate. We're also a nonprofit developer where we buy vacants. We renovate them as first-time home buyers. I'm a double contract with SBA. Everybody looking to get some SBA financing, consulting. I'm a double contract, so I teach a lot of small business workshops. And then last but not least, last year I bought a FedEx route business outside of DC and in Prince George's County. So I'm back and forth in this area. So again, thank you for this opportunity to speak and look forward to sharing some good announcements with these nice women here.
My name is Amy Griffin. Can you hear me? Say yes.
Yeah.
Good answer. All right. So I am the principal for the Life and Legacy Counselors. I am from Springfield, Massachusetts. New England folks. That means we're hardy. Anyway. So I'm going to tell you a long version because I'm a lawyer and I get paid by the word. So at 40, I was working in Massachusetts as a contracts manager for a state agency. And I realized black folks weren't getting access, weren't getting an opportunity. And if I'm overseeing it and it's not happening, we know that it's a real problem. So at 40, I went to law school. And upon graduating, I created the New England Black Chamber of Commerce, and was a part of creating what is now the U.S. Black Chambers. Working with black businesses to help create capacity and building up, contracts. And one of the brothers with whom I was working died. Pretty rude. I was doing all this work, building capacity, and died, and had nothing in place. So it was like a fire sale, because we were just selling his equipment, because he didn't have anything in place. With that, I went back to law school and got my LLM in elder law and estate planning. So what I know is it's not just what you make, it's what you keep. And in addition, while I was in law school, I had the opportunity to go to this conference called the Heckerling Conference. For estate planners, it is like the largest estate planning conference in the country. About 3,000 plus folks there. And I saw that there were no, that's not true. There were 20 of 3,000 folks who looked like me. And most of those were not community-based attorneys, so they weren't serving the community. So I knew that the reality is the information that was given at this conference wasn't getting into my community. So I created this nonprofit called the Association of Black Estate Planning Professionals. It is a collaborative economic organization with a commitment to create, conserve, and channel wealth. And we have strategic partners that include the Justice Connection, the U.S. Black Chambers, the African American Association of African American Financial Advisors, National African American Insurance Association, etc. Because we know that collectively we need to bridge the racial wealth gap. What we know is all skin folks ain't kin folks, so we need to be very mindful about making sure that we work with and connect with people who look like us, but have our values, who are committed to growing our wealth and not just sort of growing their wealth.
Thank you, Amy. That's why you're here.
All right, one more thing.
Yeah.
The Life and Legacy Counselor is an all-black woman firm.
Yes. Why I signed up. And just to touch on, to Amy's point, there's just a wealth of knowledge in this room. It's just a wealth of just black excellence, period. I mean, I've tracked every single one of you all who are RSVP'd, and we have people across finance, law, medical, IT, communications, I mean, real estate, I mean, every field. So I hope that once these wonderful individuals step off the stage, everybody connects with each other, gets to know each other, exchanges information, hopefully does business with each other. That's essentially why I built this event series to begin with. And so without further ado, I'm gonna get started. So, with that said, so the first question I'm gonna ask is for all three of you all, and then everything will be specific to your all's areas. So the first question is, how has the Corporate Transparency Act affected your practice? So let's just start.
Okay. So when it comes to the Corporate Transparency Act,
First of all, you might want to give a little overview.
I'm gonna give a definition of what it is, yes.
Yeah.
So the Corporate Transparency Act actually was passed in 2021. Congress passed it. Basically, it came after the PPP loans. You know, everybody and their mamas was getting a PPP loan. So they passed it so there could be some transparency in knowing who actually owned these different companies. So with that, early this year, starting on January 1st, they are requiring everyone to basically submit a beneficial ownership information report stating who owns your business. This is very important that you submit it. You're going to be submitting this with the Financial Crimes Enforcement Network. You have to submit it. If you do not submit this document, you can be fined up to $500 a day and even serve time in jail. So that's basically the overview.
And what's the timeline on when it has to be filled out?
So it depends. If your business was created prior to January 1st of this year, you have until January 1st of this year till January 1st of 2025. And there's other specific guidelines. If it was created after January 1st of this year, it'll be like 30 days after.
Okay, and then I got to provide any extensions, any of that?
No, you have to file on time.
Okay, all right, and has that affected your practice?
Yes, in regards to my practice, I'd say personally for myself, I filled out the form. It takes less than 10 minutes to fill out. In regards to my clients, of course, when everyone heard about this, they were all freaking out, like, what's going on? We're not trying to get fined, $500 a day, like, what do I think I do, Keisha? So I sent out a notice to my clients, just letting them know, if you are a business owner, make sure you go on the website and just fill out the form. Like I said, less than 10 minutes.
Okay.
And then I would say for me, with my clients, a lot of my clients own multiple businesses, so they have multiple LLCs. And in some LLCs they started it, but they have not done anything with it, or have not done nothing with it yet. Is it just me?
No,
so you want to make sure that you look at all the LLCs that you have filed, and make sure, because you may have some LLCs that are like not even standard that you probably haven't used in a couple of years, and you don't form like another LLC. Well, they actually will find that one too, and you want to make sure you talk to the government and give them an explanation that you're not using that LLC. So you want to make sure that all the LLC that you have are legit, they up to date, you get the information to them. But look for those phantom LLC. There's some properties that I almost bought and I formed the LLC for, and it didn't wind up going through. Then I wound up changing it, but there's some that I wound up, getting and one I'm not using and one I'm closing. But you gotta make sure even the ones that are closed, they can still try to come after you and then send them that documentation when that time arises, so they don't try to come after you, because the government don't play. They will really try to come after your money and then say something to you later. All right, so make sure you stay on top of that.
For me, how that is impacted is we have folks who have, we're being thoughtful about how do we transition ownership. And so there's a graduated ownership for families. So as we're thoughtful about how they increase their ownership or interest, we need to make sure that when they hit the right points, that their children are identified as the beneficial owners. So that's why we need to be mindful and keep track of. What do we say all the time is that estate planning is dynamic. And so we have to make sure that we stay on top of who, what, where, when, and how, all of the time. So that we need to stay current, stay aware, and make sure that we are thoughtful about how we want to move forward.
all right, thank you. All right, so next question. This will be for you, Keisha. If my business has been registered and in practice, and I am served a cease and desist letter from another business owner, what is my best course of action?
So in regards to this question, first I'm going to define what a cease and desist letter is. Some people may not know. If you are using somebody's mark and you do not have permission to use their mark, someone can send you a cease and desist letter basically saying, I need you to stop using my mark right now in regards to trademark. My mark right now or my copyright right now, effective immediately. So with that particular question, if you're saying your business is registered, I'm assuming you are talking about you have a trademark for your business. If you have a trademark for your business and you received a cease and desist letter, the first thing I would do is to respond to it. Make sure you respond, you acknowledge that you received a letter. You can let them know that you are working with an attorney to figure out basically what you're going to do in regards to the next steps. The second thing that I would do is I would research. Who sent this letter to you? Was it from someone's attorney? Was it the individual themselves? Make sure you research this information. Also, if they're saying that you are infringing on their mark, look up the mark. Are they sure you're infringing on the mark? Are they even registered? And they're saying to you that you're infringing on their mark. So I would say you can go on the USPTO.gov website. That's the United States Patent and Trademark Office website. And you can look to see, okay, is this person actually registered? Is their mark actually similar to my mark? Definitely do that research, and of course, contact an attorney. If you are able, I know sometimes, maybe in a financial bind, you're not able to contact an attorney, but of course, I would say contact an attorney. But if you cannot do that research, and then based off the research, you can actually figure out, are you infringing on that person's mark, or are you not infringing on that person's mark?
All right, thank you. All right, next question, Sharif. Could you explain the intersection, I guess this could be an Amy question too, the intersection of trust and taxes, right? Sort of where they, I guess, kind of bridge, intersect, to where I guess both of you are essentially needed. That makes sense.
I'll touch on that. I know Amy could touch on it as well. I would say the name of the game long term as you get more into real estate is own nothing, control everything. All right, so a couple of things. Taxes depends on who owns it, right? So if it's a property that you own, or if it's investments, it's going to be taxed different. So capital gain tax is going to be like 0 to 10 to 15%. If you own, we have property in it, it's going to be taxed ordinary income. And I think another thing on top of it is going to come down to, you're going to test this, is it revocable or is it a irrevocable trust, right? Because a revocable trust, that means that you put it in a trust, but you can bring it back to you. That's going to get taxed on your personal taxes. But is it an irrevocable trust? They have a tax rate, right? So it depends on what the income from that asset that's in that trust. And they got like increments where it comes up to. The highest it goes to is like 35%. When it really comes down to. So it really depends on the asset in that trust, when it really comes down to it, the type of asset that it is, based on what type of taxes you're gonna wind up paying. But you wanna make sure that you have that bail team, is what I call. That's your banker, your accountant, your insurance, that's your lawyer. So you make the best decision as far as planning, what are you gonna put in that trust, and what you're gonna put it in, when you're gonna put it in. So like me and my wife right now, we're in the process of putting more of our assets in the trust, because you go from having 2 to 3 properties, which is one thing, but then you go to having 20, 30 properties, becomes more of a liability thing, right? And that's another thing. And number 2, people always ask me, well, should I be filing, these LLCs here where I'm at, or should I be filing these in Texas, or should I be filing in Las Vegas, or should I be filing in Delaware, or should I be filing in Wyoming? Because you want to get to the point to where if somebody will try to sue you, you want to be able to protect your assets. We have that protection in other states. So you want to see where you're at as far as like how many properties that you have and how many properties you plan on having. Once you start to accumulate more assets and more properties, you may want to think about the strategic of where you file your LLCs and where you put those properties at.
There's a lot to be said. So, it's one of those things where it's like, I always struggle with people. Like, I was on a call for a long time saying, this woman going to tell me the law, right? And so, just a bit of it, right? And so when we talk about irrevocable trust, that we know that, for those of us who know this, there's a compressed tax structure. However, unless it's intentionally defective, which of course most people think you don't want an intentionally defective anything, but the intentionally defective trust has a different kind of tax structure. So that's why I say it's really important to talk to somebody who really knows this stuff, because we want to make sure that we are balancing the liability concerns, the tax considerations, but also the other things that people say. People will say, I want to start a Delaware or a Wyoming, but then LLC, but then you also realize that the state where you're operating in requires you to register as well. So knowing that, yeah, you may have the whole benefits of this over here, but you got to do double duty over here. So being mindful of all of that. And so we get to be professional pessimists. That's what I love about, we can be the, that nervous Nelly for you to help raise the consciousness of saying, nah, everything that glitters ain't gold. And so let's have the conversation of, it's not just a matter of, oh, we can just do this Wyoming thing. Yeah, you can. But no, you can do Wyoming and Maryland if that's where you're doing business.
Thank you. Okay, so Amy, if you could break down state by state instructions on how to essentially start a trust in DC, Virginia, and Maryland. That could be long, drawn out, but maybe the best, top 3.
So I really want to start with the fact that a trust is a contract, right? So if you think about it as a contract, and it's not, and each state has its own contract rules, but what we also know is I can contract with you to do anything you agree to. There are 3 parties. And anything I'm the grantor, it's my stuff. It's my stuff. I tell my kids all the time that it's my stuff.
You do.
Exactly. So we get to make the rules around it, and they don't have to agree, right? The trustee has to agree because they're the ones who are committed to doing what I say. So so while the state contract law is slightly different, if you agree to it and it's written, most times I can get away with it, right? So it can't be. I mean, there are some things that are illegal. Let me be clear. But I had a woman say, I won't say that my child can't. If she gets married to somebody who's of the same sex, they don't get my money. So there are some things that are fringe of the law. But by and large, it's my stuff. It's my gift. I don't have to give you anything except to your spouse. You can disinherit anybody but your spouse, right? And in Maryland, they're making it super hard to disinherit your spouse, right?
So real quick, just to clarify, so let's say, and this is except for if you're going through a divorce or in a divorce, is that correct? Or
so this is the thing, you better not die in process.
Right, because that spouse is getting everything, right? Yeah, okay. But otherwise, even if your odds are estranged, they're getting everything.
Not everything, and so that's the other thing, people think that your spouse will get everything, right? No, there is a percentage that they will get. And so that's really difficult when it's a house, right? So if you have, yes.
And the kids, right? Like
your kids get, so if you are married, a portion goes to you and a portion goes to your kids. If you don't have any kids, it can go to your parents. And so what does that look like when you have a house? And especially when it's a blended marriage. That's a mel of a house. And so you got to be really thinking about ahead of time, you want to protect the stuff for, you want to honor your spouse to make sure that, it's not a thing, but you want to make sure there's so many times people have houses before they get married, and so your spouse moves in, you don't want your spouse to be homeless when you die, but you want to make sure that goes on to your children. So you got to be able to create that strategy to make sure that you build it in.
And just one more quick follow-up. Between DC, Maryland, and Virginia, is there many nuances between all 3, or are they very similar?
So one of the things that, like DC and Virginia have what we call a transfer on death deed for your real property.
Okay.
And so a lot of times we'll say that and there's a life estate deed in Maryland, that, okay, my spouse gets it for this length and then it can go on. So, but you can't do a transfer on death deed for Maryland, but you can do a life estate deed. So the fractional interests are different between each of the states, but the process is pretty much almost the same. Like again, Maryland has higher standards for the spouse than any of the other places. Like it used to be that we avoid probate. We can sort of keep the spouse at bay. We just make sure life estate. But that's not the case anymore since 21 or so. It said now, my spouse, irrespective of it's in a trust, they can get what's called the augmented share.
All right. So Keisha, we're back to you. What are the primary differences, other than cost, between filing for your trademark online versus hiring an attorney to do so?
Yes. So I'd say one of the primary differences is with the trademark process, it's a lengthy process and there's several steps to it. Yes, you may just think that it's filling out a form and submitting it and you're all set, but that's not the case. Many times when you submit a trademark application, you can receive something called an office action from the trademark office. This office action is basically a legal document from them stating that you need to provide more information, that there's a likelihood of confusion. If it's a likelihood of confusion office action, that one is complicated. That one basically is stating that your trademark is similar to someone's that's already registered and you cannot move forward with that trademark. When I am responding to an office action for a client, sometimes I'm submitting 15 to 20 pages researching case law. So if you're trying to file this on your own, which a lot of times I'll get clients, they'll come to me at that stage, like, yeah, I filed my trademark by myself, and I received an office action, I don't know what to do, I have to respond tomorrow. So you're telling me I have 24 hours to try to respond to this office action, research different cases, submit a 20-page document, so you can avoid that if you go with an attorney, because we will be able to take the proper steps. Like within my firm, we search on the USPTO website first. I call it a knockout search to see if your mark is taken. Then I do a second search, which is a comprehensive search. The comprehensive search is about 200-page document showing all social media pages, all states of where there are similarities between your mark and other marks that are out there. From that comprehensive report, I provide you the legal opinion letter. I summarize it basically to 2 pages and explaining to you the likelihood of the trademark office moving forward with your application or not. So that's the difference. You get a lot more research, a lot more clarity when it comes to if your mark will be approved or not.
So shortcuts. No. Okay.
Yeah, I want to answer the same question.
Yeah, go ahead.
You know, I think about, we have so many folks who have the do-it-yourself approach, right? And especially now with AI, it creates that. What we know is you don't know the questions to ask. The other day, somebody sent me one of those websites, and I went through just to see what the experience was like. You don't know the questions to ask. You don't know how to say my child's trifling. There isn't a spot for that, right? And it doesn't talk to you about if indeed your spouse, your kid marries a ne'er-do-well, right? All of those things we get to build in, but it's a whole lot cheaper to pay $29.99. But you get what you pay for. And we don't really know. I think of Aretha Franklin. She wrote her own wills, but she gonna create the ultimate funeral, right? Yeah. And so I say to people all the time, that value, cost versus value, what's important to you, right? This folks say, no, it's expensive, but they drive a Range Rover. So really, I drive a 2007 Honda CRV, and I'm proud of it, right? But we need to be thinking about, what are we investing in? Are we investing in those things that are making us look good, or making a legacy?
Nice record. All right, so Keisha, back. Oh no, actually we're on to Sharif now. So Sharif, how does one pay taxes on the income they make on social media? Also, do you need to report also on top of your 9-to-5 job?
Okay, I think I got this one.
So also think like influencer, who also has a corporate 9-to-5.
Well, I mean, you're pretty much self-employed, so I believe at the end of the year you're going to get a 1099. So you really need to think about forming like an LLC. That would be ideal. And then have them pay it to your LLC. I highly recommend you get an EIN number, because I've seen people that start businesses and they have to get paid to them, but they're not formed as an actual business. So you want to separate that. And one of the biggest things I see people have is that they have double income going in with 1099 income, and that's a problem with commingling things. Because you can deduct the production, the expenses, and everything with the 1099 income. And I see people have that in the same account. So you want to separate them. How you do that? Form a business. Maryland Business Express, anybody heard of it, familiar with it? Do not use LegalZoom. It costs too much money. I seen so many employees legal zones, and then they forget about once you form the LLC, you got to pay $300 to keep it in good standing. And when they look and they looking to get access to capital, or they looking to do something else, first they're going to do is check to see if they get standing. So, Maryland Business Press, set up an account and make sure you file that $300 each year to keep it in good standing. Get the EIN, that's off the IRS website, it's free. It takes less than 5 minutes. They give you a separate business checking account. So who should I bank with? Look at who you bank with personally and talk to them and see if you open them a separate business checking account. Also do your research as well too. Talk to the small business resource centers. Talk to the small business development center. Talk to SCORE. These are resources where you can meet with a counselor free because you already pay for this stuff in your taxes. And they can help you navigate what would be the best bank to deal with. You want to be with a bank that's going to be bank business friendly. Right? They want to see you good. They want to give some capital and give you resources. So set up that separate business checking account and have that money go into the account. And the next thing, get QuickBooks or get some type of bookkeeping system so you can record your expenses and you know how much, because what I've seen people is they know how much they make, but then they don't keep track of any of this stuff. And then when they come to us, they want us to work miracles. And we're not going to work miracles because we can't. So you want to make sure you record your expenses the right way. The good thing about QuickBooks, or even FreshBooks, like there are a lot of good softwares out there that you can use that is online. You can add your bank account, you can download your transactions. It also has an app, and you can record your transactions on the phone. On top of that, they also have a live bookkeeper that you can hire through QuickBooks to record your transactions, so there's no excuse. And they will charge between $200 to $600 a month, depends on your transactions. So we'll make sure that you have that back end, the systems in place to make sure when it's time to file your taxes, you do it the right way. And if I got a few more, another minute or two, the difference between tax planning and tax filing. Right now, people are focused on filing their taxes, and then they want to pay too much in taxes. You have to do tax planning throughout the whole year. Meet with your accountant or meet with your business tax person on a quarterly basis to make sure you take advantage of tax deduction, tax credits, and tax strategies. I see too many just focus on filing their taxes, then they wait till the following year to get their taxes filed. I recommend you start doing that. You need to focus on it. Just like you do estate planning, you want to review that, look at that every year, at least. Or more so, every time you buy a property, every time you own and start a business, you need to talk to your estate planner. Because that's an asset. That's part of your asset. That's part of your legacy. Same thing I mentioned, you want to have that bail team. So you want to be meeting with your team on a quarterly basis so you take advantage of all these deductions so you pay the least amount of tax. And there's other tax credits and tax strategies that you can take advantage of, but I don't think I have to touch it.
Okay. And just one quick follow-up to that. So we're in February now, right? So 2023 ended. So if someone did make income via social media as an influencer and they have a 9-to-5, it's essentially going to be added to their income. Is that right?
Oh yeah, I mean, you got to report everything.
Yeah.
You have to, but it's where you report it. So it's going to be reported on the Schedule C.
Right.
Right. So your W-2 income is going to go in your 1040. But you want to make sure you take advantage of all the deductions, your printer, your computer, your home office. Like there's a lot of legal, I gotta say legal, we're in Maryland, I'm from Baltimore, a lot of legal deductions that you have to got. I've seen too many people try to take illegal deductions. So make sure you take advantage of all those legal deductions, you pay the least amount. But be careful too, because you don't want to deduct too much. And you're looking to buy a house and your income will up getting less than what you need to be. So that's why tax planning, planning is important. I tell people, you're looking to buy a house in another 2-3 years, let me know now so we know that we can plan the right way so we don't try to deduct all the stuff all at that same time. It may get to a point where you make it over 100,000, maybe one thing about becoming an escort. So you can W-2 yourself as well. You can save on some employment taxes. That's where it comes to the planning. But let people know what's your plan for the next 3 to 5 years and how you want to move it. We can all work together so it doesn't affect you build a generational wealth.
All right, thank you. All right, so Amy, we're back to you. So how do you properly structure and set up an estate plan specifically as an entrepreneur? Is there a difference versus?
So I think it first and foremost, we sort of separate our personal and our business stuff. Mm-hmm. First, and then set up your business stuff. I think one of the things Sri just said is like, don't just all of a sudden, go out and say you're a DBA. Right. While you can legally have a business without using your social security number, when you're trying to create something that has life to it beyond you, you need to create that separateness from you and then have the estate plan for your business just like you have it for your person. One of the things that we say in our firm is being mindful of the D's of business succession planning: death, disability, divorce, departure, and dissolution. Those are the things that you should be planning for your business, because, you know, I just want to also point out, Leah and Ayana are both estate planning attorneys as well here, and so knowing that if indeed you are just planning for your person and not your business, when something happens, you create a whole level of hess, and you spend time in court spending all that money away, because the law requires that the business, conceptually, it says that in 9 months it's got to be wound up. What can you do with that? So I encourage people to have the plan that is separate and distinct, that really embraces what you want to happen. One of the things, I'm a person of faith, and so we always talk about sort of write the vision and make it plain so those who can see it can run with it. So have that vision, that plan that's supposed to be bigger and greater than you, and so that you can have that plan written out, so that I say all the time, I've been building my practice such that I'm planning to die, right? And there should be enough folks there that, I say this all the time, I want them to have a snot-nosed, ugly cry, but know that the next day, you gotta take care of the folks that are taken care of. We should all have that plan. No matter what the business is, no matter where we are, we should have a plan for that goes on beyond us.
Yeah. And I'm just going to add quickly to that, just because I've worked closely with Amy at this point, and as I mentioned earlier, it took me almost 2 years to get my estate situated, and a lot of it was, you know, being a single black female, not married, no kids, like, who am I going to leave everything to? And having like anxiety trying to think about that and put that on paper. And I just, you know, wanted to kind of give you your flowers in terms of really sort of helping me think through that. She recommended bringing my Black Girl Magic posse, you know, kind of leaving things to them, and really try, especially from a business standpoint, because one of the first questions you ask me is like, do you want your businesses to die with you or continue on? And you really got to process and think about that, you know, and then who would you leave it to, right? So, and do you need to start molding those people right now, you know? So, I mean, I have a niece who's 12, like, she's probably not ready, but, you know, I can kind of start having those conversations much sooner to kind of start molding if she's the one, right? Or maybe it's my friend's kids, who knows? So,
but let me say that a lot of times we believe that our kids are the ones. Sometimes they're dumb as a rock, you know, but they're cute. Right? Sometimes they have, you know, but you know, sometimes, like my daughter was confused when she was young. She thought she wanted to be a doctor. Praise the Lord, she found the way, she's a lawyer. But we need to be thinking about, if not, what? Right? How do we plan for it accordingly? We don't have, I mean, sometimes it's just not the right thing. Now, I am controlling, but not in this case. We don't want to force them to do what they want to do. We just want to make sure that it is successful. And so I say to all of those, you know, solos that start out, make sure you have that succession plan so that your clients aren't stuck afterwards, right? So, and let me say that those things is, we ought not, I'm putting my Black Chamber hat on. We ought not always be solos. We need to be thinking about this, and it's a struggle coming together because we're better together, right? The economy of scale is real, and what we know is, I will tell you, it's so many folks. I want my own. You can have your own of 100,000, or you can have somebody else with somebody else be 10 million. Let's be thinking about how do we grow together and be together. A little sidebar.
Yeah, that was a word. Thank you. All right, so Keisha, we're back to you. So what is the typical timeline from the time the trademark is filed until it's officially trademarked?
Yes. So the timeline right now is about 12 to 18 months. And I know everyone's like, wait, what? How long? So With the trademark, the first step, as I stated, you do the search to make sure the mark's not taken. The second step, if you're doing it by yourself, you won't have this step as far as me giving you the legal opinion based off the comprehensive report, and then we file the trademark. Once we file the trademark, an examining attorney at the trademark office, they're not looking at trademarks right now. It's taking between 7 to 8 months for them to even look at your application. Once they look at your application, then that's when they'll have, if there's an office action that needs to be submitted, they'll send an office action, and then from the office action, respond to it. If there's no office action, then they'll post it in something called the Official Gazette, which is the online trademark newsletter. They'll post it there for 30 days, just in case if anyone wants to oppose your mark, they kind of give them a last chance to say, hey, that's my mark, they can't move forward with it. After that is done, then it takes another about like 6 to 7 weeks for them to send your official trademark registration. So it's important that you get in, because at least if you get your trademark application in, it's in. There could be someone, say for instance, if you get your trademark application in today, and then a week later someone else wants to submit an application. We can send them a cease and desist, say we have a pending trademark with the trademark office, and this is our serial number, so you need to stop infringing on my mark. So it's good just to get the trademark application in.
And real quick, once you file, you can then use the TM symbol, or is it something else?
No, that is correct. Even if you haven't filed, you can actually use the TM symbol next to your business name, your slogan, whatever it is, or your logo. Once you actually receive the registration, I know many of you probably see that R with the circle around it saying registered, that's when you can use the R, but yes, you can use the TM.
Okay. All right, so we're back to you, Sharif. So how does one set up a tax plan after the purchase of a property or properties?
Yeah, that is so good. So when you get to the closing table, you're going to get that HUD one or you're going to get that CD. So next thing, you need to talk to your accountant. Don't wait until it's time to file to talk to you. You need to talk to them right now. And when it comes to that tax plan, when you buy that property, you got to make sure you get your books in order, right? So there's a software called, have you ever heard of Desist? Like, you got to record your transactions just for that property. So you buy that first rental property, what you got to record? The insurance, the taxes, the utilities, the maintenance. Like, you got to have something that's going to record all of these transactions. Then you got the depreciation on top of it. So make sure that you have a system in place to record your business expenses and a system in place to record your expenses just for the property. Now, you bought it in your name or you bought it in the LLC. It's going to make a big difference. So if you buy it in your name, it's going to be on the Schedule E, right? And you also got to think of something called PAL, past activity loss. If you make over $100,000 over a certain amount, you can only deduct the expenses all the way up to the income. Well, how do I get past that, right? You got to show that you work a certain hours, get the registered license, or if you buy it or refinance it or buy it in the LLC, then that is not on the Schedule E, then it's on the Schedule C. Then you can bypass that and you can take those deductions. So you got to be strategic how you buy properties as well too, because they can put limitations with type of deduction that you can take. So that's why I highly recommend talk to a tax professional, set up on quarterly meetings, get your system in place, how you're going to record these transactions. I recommend against Desist. That's a software you can put your properties on there, you can put your bank account, you can record all the expenses, you can assign to which property that it is, and you're going to have to pull those profit loss statements or those balance sheets. And then also too is, I'm not sure if y'all work with a property manager, make sure you have a good property manager as well too. Not a property manager, but have a good property manager. So they can stay on top of your stuff and you know how your property is doing, if there's any repairs or anything that needs to be done. And also they can, sometimes they have a software where they'll send you a profit loss statement, but many of the people I know, when they got 1 or 2 properties and they bought it in their name and then they bought another one that's in their name and refinance, a lot of times they don't have a property manager, so it falls on you to record your transactions. So make sure you have those systems in place that make sure that you record those transactions and that your taxes are being prepared correctly.
And spell that system that you were talking about.
It's called Stessa, S-T-E-S-S-A. It has an app as well too, so it's no excuse for you not being able to record your transactions. Highly recommend. And then also, again, you gotta think about the depreciation when it comes down to it. Now, rental properties is not just a house, it's not just a multi-unit, but how many own a business? Has anybody ever bought their office building? Anybody ever bought a building? Bought an office building? Good. So another thing too is, You know, depreciation is taken in two different ways. When the residential is 27.5 years, this commercial is 39.5 years, right? So many of you that own a business, you have a home-based business, right? Think about in a couple of years, think about buying your own building. Because that's the mindset. If you're really trying to build wealth, don't just think about buying a business, but buy your own building. And you can actually buy something called, anybody familiar with a mixed-use building is? With a mixed-use building, storefront, basement, then you have an apartment on the upstairs. Then the apartment actually is cash flow that actually help you pay your mortgage. I bought my building in 2018 in Baltimore for $150,000. 2 years later, it appraised at $225,000. So what you think I did? I refinanced it and I bought another building on the next block because there's something called depreciation and then also something called appreciation. There's no other investment out here where you can get the depreciation on the investment and also appreciates the value. So you can create your own bank and create some cash flow and you use that to buy other property that are already cash flowing. So now I rent out that apartment above to travel nurses. So now you get, instead of getting something per month, you can get something per week that makes more money. Then on back of that, I have a lot, so I got a showroom business. So I got a couple of vehicles that I rent. So when you own it, you can turn one stream of income to three types of income. And you can deduct those vehicles that are back there and the apartment that's up there, you can appreciate that building and put it in a separate LLC. I call it a special purpose entity. So if someone were to sue your business, they can't come after the property. And you can actually put yourself on lease. And with SBA, as long as you occupy 51%, you can rent out to 49%. People don't know that. And you're only putting down 10%, right? So there's ways where you can keep your down payment low and your bond center is already cash flowing. And you get the depreciation on top of it.
Thank you for those gems. Yeah. Somebody's excited. Okay, so now we're on to you, Amy. So what is the process to add investments in a trust versus being in your name?
So again, it depends on what kind of trust you have, what kind of investments you have, right? If they're investments that are potentially liable, you don't want to put that in your personal revocable trust. But if you have investments like...
So real quick, I'm going to stop you. So if you could explain revocable versus irrevocable, just for those who may not be familiar.
Certainly.
Yeah.
So a revocable trust, if you think of it as an extension of you, I was thinking it has your social security number as an identifier. If you think of it in business terms, it's like a DBA, right? So it is as good, it's an extension of you, and it lasts as long as you do. But if someone sues it, they have access to all your stuff, right? Because there's no separate, your personal stuff, because there's no separation. An irrevocable trust is like a corporation, and it has its own EIN and operates independently of you. And so you lose some of the ownership and control perspective of it. So there are some limitations you have on it. But if someone sues it, it doesn't get access to your personal stuff. So there's separation. And so you're being very thoughtful about what you put in there. Just think about a closed box and everything in there, like it gets contaminated together. Okay? So it's many ways comparable to a corporation or an LLC if you think about it like that. Okay? We think about revocable trusts. I always use them as legacy building trusts. You put your personal stuff in there and you identify the rules for multiple generational wealth building. How do you want to strategically structure so that the wealth can continue to grow from generation to generation? As well as we can do an irrevocable trust. We talk about that as an asset protection trust. And so the things that are in there are safe, right? And so, but it's not identified as yours. So we use that when we're talking about estate tax exemption because it's not yours. We talk about that when we're talking about even special needs trusts. Things are in the irrevocable trust because it's not yours. And so a lot of times we put businesses, etc., in an irrevocable trust to create separate. However, if you're having an 8A or a women's business owner or a a color business, then it loses you can't use an irrevocable trust because it has to have your identity. So,
Okay. All right, so the last couple questions before we'll open it up to the attendees, we'll go to you, Sheree. people have questions. So the next one is the best practices in protecting your investments as they grow, which that might also be Amy too. What would you say, maybe top 3 best practices?
Of protecting your investment. Marry the right spouse. I'm just being honest with you. Yeah, if you marry the wrong spouse, they will get.
And or get a prenup.
Yeah, tight one, every time.
I'll be good at that. So I would recommend that you do that. LLC is ideal, which I think would be good because it's a separate entity. I think as your business starts to grow more and more, you think about creating a holding company. All right. And then from the holding company, as your business starts to grow more and more, you start having different businesses, you have different, DBAs, because you have your main company and you have other businesses under that. But then think about long-term putting it into a trust, because that's what we're in the process. We've done that and we've updated and put more, pretty much all of our assets to a trust, because we know if we die, we want to be able to make sure that everything is, pan out the way it's supposed to be. So I highly recommend that. Also, think about having possibly, if you can afford it, an IUL policy, equity index life insurance policy.
Real quick, I'm going to shout out our sponsor, Maurice Carter, New York Life. We're talking about all the IULs, BULs, I got all the things.
Because you do need life insurance.
Yeah.
You highly recommend it. I got licensed, we definitely took 20 years ago, and I saw the importance. Because I have term, and then when I, buy a business or buy a building, I get a term policy and I get an IUL policy with both the customers. So if something happens, it get paid off, and the property goes tax-free, and there's money that's going to my family and going to my wife tax-free. And the last thing I want her to worry about is she have to sell this, she have to do this. And a lot of times it happens, they're not even thinking, because they may even sell it for top dollar. They probably just want to get rid of it because it's a headache. So you want to make sure you have stuff in place. So have the LLC, have the trust, have life insurance in place, which is very important, because that money passes tax-free to your family. And if you do have the IUL policy, you have it for 10 years, because it takes a while to build it, you can borrow from it. You can be able to use it for other different things as well. But please make sure you have that life insurance as well.
Thank you for that.
Can I add to that?
Go ahead.
One of the things that I always say to folks is, if you have life insurance for your loved ones, remember, it's like a lottery winning. An inheritance can be that way. So I encourage people, put it in a trust so you have rules on it. Lottery winners are 4 times more apt to file bankruptcy than a typical person. So have the life insurance beneficiary be the trust. In many cases, depending on what the limit is, having an ILIT, which is the life insurance trust, irrevocable life insurance trust, and it's in there, so it's not a part of your estate, but you can plan for it. And so I encourage you to give rules so that it is provided over time as opposed to one big check. I'll never forget the client who ended up had a Maserati and a Jag. After his mom died, he didn't have a job.
Yeah, I've seen that. Yeah, if I can add to it, you ever heard of John D. Rockefeller, Wilbur Rock? Highly recommend read that book, What Rockefeller Do. A dynasty trust. I mean, everything they do, the trust owns everything. Even when they take out life insurance for all the family members, somebody passes, that money goes into the trust. And then when any of the family members want to buy a house or start a business, they don't have to go to no bank, they just go to the family and they vote on it, and the family is the bank. So it's called infinite banking. So I highly recommend something to think about doing, infinite banking. Think about having that life insurance in the trust and creating your own bank. Because Rockefeller to this day is still the wealthiest family in the US. So think about this book called What Will Rockefeller Do. I highly recommend you read that book.
So last question for you, Sharif, is what are changes in tax rules that were implemented in 2023 and this year, 2024, if any?
It's not too much. I mean, the standard deduction changes, when it really comes down to it. I think the major change going to come is when we find out who's going to be the new president in the administration, just to be honest with you, when it really comes down to it. I know they was arguing about the child tax credit and trying to save that and things of that nature. But the biggest thing I would say when it comes down to the tax laws and, you know, the tax, everybody's situation is different. Whether you're married, single, hit a household, I would recommend for every single one of you, you know, make sure you have yourself in order when it comes to starting that business. Have those systems in place and make sure you're recording all of your transactions, because it's not just if, it's when the IRS is going to come. Because they got a whole separate division just to audit small businesses. So you want to make sure that you are audit proof. So you want to make sure that you have all your stuff is in order. You know, have those file folders, like an electronic file folder. If you got receipts, take a picture of them, electronically send it to yourself. Don't just go to your account and get them box of receipts. Because what we're going to do, we're going to get it right back to you. Because a lot of times we don't know what you done paid for. So make sure you have your stuff in order.
Okay. All right, well, that concludes the questions that you all submitted.